now. Let's take the conversation forward. Manish, fantastic to have you back and thank you for joining us. Manish, it's been a heck of a ride. Who would have thought, forget March lows, even from where we were, let's say in the month of October, we would be anywhere close to 13,000 on the Nifty and we would be at 45,000 on the index. How much of the market, to your mind, is only a function of liquidity?
Well, I think liquidity is very important, very difficult to quantify, but definitely not only as liquidity, I think directly played a role in the market. But even if you look at leverage companies, the banking system, which is a big part of the index. From a more fundamental perspective also, liquidity obviously has been very helpful. So if you see, we're seeing deals in real estate, infrastructure, where a lot of leverage companies are able to divest their assets at good valuations. In fact, we're seeing a flurry of deals recently. And that obviously is changing the perception of asset quality for banks as well. So yeah, liquidity in various forms from various angles has been, I think, key to this recovery. As you rightly pointed out, very difficult to imagine 6 months back that after a once-in-a-100-year health crisis, we could be back so soon. But it's also, I think, playing out in the real world. So if you see even the economic data, both globally and domestic, to be honest, even that 6 months back, it would have been difficult to predict that real estate sales, auto sales would come back so strongly. So I think it's both fundamental and liquidity driven. How much is each is obviously very difficult to split. But yeah, I think things are looking good all around right now.
Okay. When news is bad, prices are good, and when news is good, prices are bad. Now news is good. Are prices bad?
Not really, Nikunj. If you see, prices are probably bad from March lows, but if you see from 2018 Jan, a lot of stocks in the cyclical sectors are still lower. The interest rates are lower versus Jan 2018. So you could argue that what we call ERP or the discounting factor, whatever term you may want to use, essentially the P's need to be higher to factor in the lower interest rates. So in absolute prices, stocks are lower, interest rates are lower, and you could probably also argue that the outlook for next 3 year earning growth is better right now. So yeah, prices are bad versus March in a lot of cases, but normalized cycle may be fair value right now.
Manish, there seems to be a change in the market direction, which is cyclicals, industrials, they are making a comeback. Steel stocks have had a fantastic rally. Cement stocks at an all-time high. Which way would you lean now? Would you go back to the original leaders, which is, let's say, IT and pharma, which in a sense started outperforming, or now it's time to stay with the current leg of outperformers, which is cyclicals and industrials, cement and steel?
So I would place my bet, maybe it's a gut feel or whatever, that value will outperform. I think that's the bigger question rather than the market level at this point of time, because if you look back what has happened over the last 18 years, every time the economy normalized, the global economy as well as the domestic economy, it did for 1.5 years, and then we had a shock. So in 2013, we had a Fed taper tantrum shock. In 2015, we had a China debt problem and yuan devaluation shock. And 2018, we had the US-China trade war combined with the NBFC crisis domestic. Now the big question is, this is basically, I think, a very accelerated cycle. So from March, if you see, it's been a very traditional cycle where first pharma IT did well, which are obviously the better balance sheets. Then the retail banks did well, which are a bit more cyclical, but still obviously decent balance sheets. And now we are starting to get into the third phase where, the leverage stocks, the PSU stocks, they've started doing well. But I just get a feeling that there is potential for this to be the big one, where we don't get a shock for a few quarters or maybe a couple of years as well. Because with each of these cycles, these stocks have got cheaper and cheaper. So the starting point is very, very low. So you don't need much. You just need no shocks to happen for a lot of these stocks to do well. And given that we've had so many shocks, it does look like there is a good chance we may see a lot of these value stocks outperform. I think it's global as well. So I think we need to be nimble. We need to see what globally, whether FANG stocks are dominating or the caterpillars or ArcelorMittals are doing well. But it does look like the momentum is behind value stocks. And given the normalized valuations again, obviously the bigger upside is in this category.
Absolutely. So if one were to just go a little deeper into that, Manish, materials, for example, give me a sense of the opportunity or, the way in which you'd probably look for quality picks within a basket like that.
Well, on an aggregate, obviously, you're not going to get great quality in the traditional sense of the term. But I think you still have very good companies in CVs, steel, industrials, real estate, utilities, which are trading way, way below 2018 levels on absolute levels, which are trading with dividend yields of 8-10%, which are trading 0.5 book, 0.3 time book. So you, whatever relevant valuation metric you look at that particular sector, you definitely have enough opportunities where you can say that if the 10-year average valuation were to come back, or if dividend yields fall from 10 to 5%, the stock can obviously do very well. So yeah, across segments in metals, commercial vehicles, energy, industrials, real estate, cement, a lot of the mid-caps specifically are quite cheap.
Absolutely, and clearly the market's also now turning its attention to that. So, as attention does turn away from the index, Manish, what's the kind of catch-up time frame you see? We're talking about an accelerated rate that we've been observing so far when it comes to this rotation, participation from the broader markets. Do you see this also picking up pace now?
Well, I think if value has to outperform, it has to be. I think it will be very sudden and very sharp and not a very prolonged thing. See, the point is that in a business cycle, at some point, the interest rates and commodities become a drag for the high quality consumption or staples kind of sectors. And I get a sense that if that can be called the halfway of the bull market, I think we are already there. So basically, the total market cap of the economy can't go beyond a point, because obviously if steel and crude go up, then your consumption sectors start getting hit after a point. My sense is we're probably not very far off from that point where, if you remember in the 2003 to 2008 cycle, 2006 mid was that point where the value stocks started outperforming, and the consumption stocks didn't do anything till the financial crisis. I think we're probably closer to that point now. And then if, as I said, if the economy from a both global and domestic sense doesn't get a shock, it's quite possible that we may see the commodities value style work. And if it works, I think since this seems to be a very accelerated cycle, I think it will play out quite fast.
positioned when it comes to the PSU pack in particular? I was just looking at the data, and the CPSE ETF itself has surged about 13% in the last 14 days, as now the government's intent on disinvestment, which has in any case been quite a derailed process, seems to be picking up and gathering steam yet again. We were just looking at the PSU index performance itself. It's a staggering 20% uptick coming in the last 1 month alone.
Yeah, clearly there's a lot of value out there, but I would also feel that it's not. A lot of times we ascribe domestic factors to all this, but I just feel that the way Indian markets work, the styles which work, or the sectors which work, has a lot of correlation to what's happening globally. So when you look at a CPSE or other value stocks outperform, it's quite noticeable that all this started when FANG stocks also started underperforming more prominently since the November first week, when the presidential election and vaccination data came out. So I think it's a good thing to see what the Nasdaq is doing versus Dow, and that probably will give us a direction of value versus growth. Coming to CPSE or PSUs in general, obviously, as a stock picker, rather than CPSE, you want to play select stocks within the PSUs also. So some of the technologically or any kind of disrupted sectors you still want to avoid. But clearly, even if you exclude that within the PSU basket, I think there are a lot of stories with secular kind of growth which are trading very, very cheap.
Sure. Within the PSU pack, though, Manish, where is it that you're standing when it comes to PSU banks in particular? You know, against the same rationale that now there is going to be this sectoral churn, the more bottom-up stories which are coming to the fore. It started with SBI, and now the move has been trickling into some of the other PSU banks as well. You think there is merit in looking at the PSU banking space in particular?
So my feeling is we're looking only at the largest one. See, banking in this cycle, there is a cyclical component which obviously can help all PSU banks. But I think if you look around the globe, a lot of market cap has migrated to fintech. So technology is also going to be a big factor in the banking space, which is a more structural factor. So you have a kind of conflict here with the small PSU banks that, yes, the economy is picking up, asset quality concerns are receding, and the valuations are very, very cheap. So anything which helps asset quality can result in a lot of enhancement of value. But at the same time, you also have a structural component about technology becoming bigger and bigger. You're already seeing that the top 3-4 private banks across cycles, pre-COVID or post-COVID, their advances growth is materially above the PSU banks. And the market share shift is accelerating quite fast, not only from PSU banks, even from some of the NBFCs and smaller private banks. So it's becoming a bit of a consolidation game in banking, which is why I would feel that going beyond the largest is not something I would favor at this point of time.
Okay, fair enough. So those are a couple of the key points coming through, from our conversation with Manish today. Manish, while we've been focusing so much on what is to come, what about some of those pockets that have continued to be a strength through the last few months, IT, pharma, of course, and they continue to be. We continue to see traction there. Do you feel perhaps that the return expectation now at these valuations should be a little modified going forward, or are you still incredibly bullish?
No, I think obviously the return expectations from these sectors have to be toned down quite a lot to my mind. I generally feel that IT might just do a bit better than pharma because IT has a bit of a cyclical component, and IT doesn't have a raw material component. So if the commodities do well, some of the pharma companies which have seen phenomenal margin expansion in first half of this financial year could face some headwinds on that side. Also, you have to see how the new administration in US or what is their view on drug pricing, which could create some noise, which is adverse for the sector. So I think there's not super normal upside in these sectors, but I think that IT can be the dark horse among the two, maybe.
Super nominal upside, let me use that word. Manish?
Yeah. Hello?
Now, since you said IT is not going to give super nominal upside, let's talk about a sector where, or a theme or a business where you expect super nominal upside.
No, Nikhil, as I said, at this point, it looks that the second half of a full-blown business cycle bull market can happen, in which case, across the spectrum of corporate banks, commercial vehicle, real estate, building materials, I think those are the sectors which have not performed for 5, 7, maybe 10 years. I think that is where the supernormal upside can come from a cyclical perspective. Now, when you have a portfolio, obviously a lot of the portfolio will still be in structural stuff. And on that side, I think, again, the theme of Chinese manufacturing shifting to India will continue to play out. A lot of the stocks, to be honest, whether they are in chemicals or electronic manufacturing, are not very cheap. But at least I think there will be compounding of earnings there.
Okay. A data point which is not adding up for me, Manish, is FI flows at a record high, even on an absolute and a relative basis to India, markets at an all-time high, and DI selling at an all-time high. Normally these things don't exist. When markets are going high, DIs they buy and FIs they buy.
No, so I think it's a good thing actually. So if you see the mutual fund had inflows in March, April, May kind of time frame. And I think it's a good thing for the market if DIs and FIs are acting against each other, because that keeps the market sane. So at this point, obviously, the mutual funds are seeing fairly significant outflows, which I guess is just some kind of profit booking for the inflows that happened for over last many years. I would think over time, if there is a small correction, this should reverse as well. So I think it's good for the market if both don't act together, because then you could be, building up a bubble very soon. Given the way the market has moved, in fact, I think we should breathe a sigh of relief that the DIs are selling, because the market was up about 12-13% in November. You don't want the entire gains for next 3 years to come very soon, right? I mean, you just want a more steady market which doesn't go into bubble territory. To that extent, yeah, I think it's good.
understanding when you speak to some of your counterparts and some of the peers, is this redemption or this is just a view on the market where funds are currently or local funds are currently raising a lot of cash? What I'm trying to understand from you is, are you sitting on slightly higher levels of cash and whenever markets come down, DIs would be shopping again?
No. Because I don't think it's cash raising. When I look at our own house or other houses, I don't see a material difference in cash levels. So it's just the redemption part, I think.
All right. Thanks so much for joining us this morning, Manish. Always a pleasure chatting with you.
Thank you.